Good morning, everybody. It's Wednesday, and we're back with another live show. My name's Bill McKinley. I got Jeffrey on the Skype, and we're going to talk about the market. We're going to talk about some of the stocks in the trading service, and we're going to look at some different examples and stops and all that. So let's get started. First thing I wanted to look at was actually the market itself because we're kind of at an interesting juncture here, an extremely interesting juncture. And I happen to have one of the charts up on the screen that I typically look at. It's got a 50-day moving average and a 200-day moving average and a MACD histogram. And I'll tell you what's crazy interesting about this, Jeffrey, is, and I mean, everybody obviously is looking at the same chart here, but it just seems almost uncanny that this recent run up since the beginning of the year literally has, so far anyway, has seemed to got stopped right in its tracks at literally the same spot that we were back in October, like this first little dip here. And what's crazy about this is that this high right here was 28.1694, and the high of this past Monday was 28.1688. So it was like a lower high by just a few pennies, but it's just amazing that it literally ran up to that same spot there and got turned back. What do you make of this pattern that we're
Well,
looking at?
it's proof that the market has a memory. Yeah, it makes sense because yeah, those are the big levels that everybody's watching, and uh, remember that we get what's called overhead supply, and what that means is that there were enough buyers that bought right at that level, and they obviously made a mistake. So, and they incur drawdown then after the market backs off. So anytime the market gets back up to that level, there's a lot of selling that goes on just to get out where you got in, right?
Yeah, sure. And there was
And
actually
that's
a couple of bounces like back up towards that level, right? Like the first time there was that big sell-off in October, it sort of bounced up there, but then there was a big pullback, and this next sort of bounce up to that level probably sucked a few more people in, like you say, and created even more overhead supply.
Yeah, so we get this overhead supply factor, and then the other half of the players who are playing the market, they realize that that's likely a rejection point or a stopping point, and they'll trade up to those levels, and then that's where they cash in. See, so it's a self-fulfilling type of a prophecy thing that drives itself. Now, eventually, if there's enough accumulation that goes on just in general, remember we're looking at the market, so the market's made up of in this instance, the 500 stocks, right?
Mhm.
So if on average across the board there's enough accumulation that just continues to build, we'll eventually bust above all that overhead supply, and the market can go on and go to new levels, new higher levels. So yeah, it'll be interesting because 3 days ago we had that big long range outside day, you notice, and
Yes.
that's the balance point right there, right down. If you put a horizontal line right down the middle of that big bar, that's where the market's going to be on a teeter-totter right now. So uh, I think that you want to watch those two extremes, the high of that day and the low of that day, for what the next leg of the market's likely to do.
I was just about to say that. That makes total sense because so far, well, like you say, that particular day there, it looks like it closed about halfway back up in the range, and so yeah, it seems like there would be buyers above that high and sellers below it. I'll tell you something else that's kind of interesting here. This thick gray line is the 200-day moving average, simple 200-day moving average, which is like probably one of the most common moving averages when somebody first starts learning about technical analysis. That's the biggie. But let me ask you this: since the 200-day moving average is essentially moving sideways, does that make a difference as opposed to if it's trending, right? Because the way that I think about it is, I mean, look at these breaks above and below the 200 day. It was just going completely sideways, right? And just like it is now. So I don't think that it's really as effective of a measure of anything due to the fact it's going sideways as opposed to, like, say this 50-day moving average is starting to actually trend up. So say the market were to sell off, that 50-day trending up would be sort of more important of a support point, right?
Yeah, and moving averages provide visual reference points to a degree. And like you said, the 200's a big one that everybody watches, and but in this instance, really what happened here is with the 200 trading fairly horizontal. Um, it acted more as of a leash to pull the price back to it.
Mm.
So notice how over on the left side of your screen, how price basically was kind of chained to the 200, and it tried to move above it, and then it moved below it, and moved above it, and moved below it, and then we got that big move down, and then all we did was we sucked right back to that line, the 200-day moving average. So um, I think that trying to figure out what the market's going to do next based on the 200, there's nothing to go on here, right? We just got sucked back to that which had been kind of the your linear regression area was tracking that 200. So the uh, the usefulness of the 200 was probably in the move all the way back to it, which is over now. So,
Sure.
but like you said, the 50 is turning up, and so that is a positive sign. It's, technical analysis goes so far, and especially when it comes to the market can do basically the market could do anything it wants to at this point. It can go higher, go lower, or just stay sideways. So it's a total coin flip. What we're going to see happen here.
Yeah, it would be interesting if we actually see some sort of sideways consolidation here between the 200 and this overhead supply. One thing that I did notice is that if you draw a trend line sort of, across the lows of the recent, there's been a couple of little dips lately, right, since the beginning of the year. And this is quite a tear. I mean, the market actually went up from 20% from the lows down here around Christmas time up to this recent sort of outside reversal day. And so it's kind of interesting. It seems like the momentum, which you can tell by the MACD's gone negative here, the MACD histogram, meaning that the momentum of this sort of rally has kind of run out of steam here. No big deal, but it's just sort of like you say, a visual sign.
Yeah, if you take, I don't know if you can go to a weekly chart, but if you go to a weekly chart, then we get a kind of a different view of the market, which uh, kind of favors a potential continuation to the downside if you take a look at the weekly.
All right.
And that's just because we've had so many weeks up, and we're literally just getting our first week where we're going to see a lower close on the week.
Mm.
If everything stays the same this week, so that could, you could say that's going to be kind of like a bearish engulfing on the weekly, and in that sense, it looks like the market could continue to pull back a little bit, another week or two. But again, the market does what the market wants to do, and you can try to read the tea leaves so far, and uh, really with technical analysis, what we do is we're not trying to figure out everything that the market's going to do next, or we're not trying to figure out everything a stock is going to do next. We're using the technicals to wait for tried and true patterns where we do have good statistical follow through based on that exact pattern. So you see the difference in how we use technical analysis. One is to locate these tradable high frequency patterns, and the other would be to try to predict everything that's going to happen next, which that's what that's the losing game.
Yeah, sure, sure. So, and of course, we're in sort of a news driven market right now. So, I'm going to go back to my daily chart here. the one that I have that doesn't have any moving averages or anything on it. This is just a real nice, clean look at the market, and I feel like when we do the show, especially the way I have the charts marked up, that looking at this real nice, simple, clean, open, high, low, close chart is the way to go. So, there's a few things I wanted to look at today. One was the first one, I thought we'd do something a little bit different today, so that we're not sort of redundant. Uh, and so, what I wanted to talk about this morning was the parabolic stops. All right, so we've touched on those before, obviously, talked about them as we've looked at all these and marked them, but we've never really dug into the parabolic stops and sort of how to use them and what to look for and a little bit about them. So what I wanted to look at was this Intel, which is probably out of all the charts that I have marked up, this might be one of the best examples that we actually have of how the system works, just because I've somehow managed to keep up with all the trailing stops. Isn't that pretty? Isn't that just the way that these trailing stops sort of ratchet up along with the price and keep you in the trade. And by the way, this one is still open, and so that's what I wanted to talk about a little bit today. I've managed to keep up with these parabolic stops, and so do you want to talk a little bit about? I mean, the stock doesn't really look parabolic when you look at the chart. Let's talk about what the parabolic stop is, and how one should use it and look at it.
Sure. Well, just to give a quick overview, we've got the system target gets generated on the day that the stock triggers, which is we're looking for a 1 day close above the trigger line. All right. As long as that stock trades is closing below the trigger line, you just keep your hands off of it and you wait for that trigger. That's your first hint that you could get into a trade the next day. So once we trigger, the system will compute the target. And the target's based on that particular stock's ATRs and its pattern at that point in time. There's some formulas I came up with. I don't really use the true ATR, which takes gaps into effect. I have a special formula I just created to figure out the ranges, and then we basically, the target, just so you can understand, is based on our trick formula for the range that looks at 20 days of range. It computes at 3.5 point times that average range at that point in time. That's how we get the target. High frequency follow through on the targets. But the system, the main system stop, which you see in the red there, that kicks in right away also, because that is your protective stop. That's to prevent catastrophic loss. So you just want to keep that initial stop in no matter what, and then you can move that along with the system. Now, again, just one final thing in the closed trades, we've mentioned this before, that for a trade to get closed out, it actually does have to hit the main system trailing stop, right? The initial trailing stop. And that's the red line.
Sure.
Yeah. Now, so where does the parabolic stop fit into all this? So let's say that we didn't have the parabolic stop. You'd have two methodologies to take a profit. One would be to run up and hit the target and just take your profits, and we've hit the statistical high frequency follow through that we're going to see in a lot of these stocks, so you could just take your profit there. The other profit methodology would be to just follow that system stop up and let it take you out. So in other words, you're not making a decision on where you're going to get out. You're going to let the stock price knock itself out based on the main system stop. Okay, so those are the two basic things that you have to work with. Now, the parabolic stops, where do those fit in? What the parabolic stop is a point where the system is detecting that the current price trajectory is overbought enough, parabolic enough to where that price probably can't be sustained. Okay, It's just a statistical thing. Obviously, we can see that we've got parabolic stops that have gone in, and then price goes higher above those, right? But that is just kind of like a little warning sign that, hey, the market shot up really fast here over the last few days, and just based on the pattern and the momentum, it's very possible we could pull back, right? So you can use those parabolic stops to your discretion, right? So let's just say I mean, there's a lot of different scenarios of why we make the trading decisions that we make, right?
Hmm.
I'll give you a perfect example. Let's say that this stock up here this is Intel, right?
Yeah.
So notice how the price is running up, and then we were below the target, but we got that first parabolic stop kick in, right?
Yep.
Now, what would be the best way to play that? Well, get a stop in at the parabolic stop, and then maybe leave it on that first one, and then you've got price bracketed now between the parabolic stop and the target. It's going to hit one of the two, and either one is a win, right? And again, this can be done on your full position, or you can cut your position in half. As you trade bigger and bigger size, it behooves you over the series to take profits when you can, but leave some in for the longer term, right?
Hmm.
That's the best way to like eke out every possible gain you can get out of the markets.
Sure.
So that would be one scenario. Another scenario would be that let's say that you took profits on half at the target, right? And you'd been following up on the regular trailing stop just to again prevent against any kind of catastrophic loss, as well as lock in whatever kind of gains the system is telling you to lock in. But let's say that another scenario is you took half at the target, and then the second half you let run a little bit further, and you use the parabolic stop to take profits on that half, right? That's another way you could do it. So one thing to get your head around is that with the different scenarios that we can come up with, and the trades that you're going to be doing over the series, many trades, and you're going to have different scenarios and maybe different follow through on different trades, and you're going to make different decisions at different time. It And I mentioned this before, it kind of averages out,
Mm.
right? In other
Hmm.
words, if you did 1,000 trades, Bill, and I did 1,000 trades, and somebody else did 1,000 trades, it probably kind of all averages out to around to the same thing, right? I mean,
Sure.
yeah, I mean that's just the way it would work.
Mm.
So I'll give you one other really quick scenario, and then basically I'll finish. Let's say that you were in a position, or you were in a bunch of positions, and the market goes on a tear, and um, forget where the target is, but the prices are running, you know, uh, running in your favor, and you're getting these parabolic stops kick in, and then you're getting ready to go on vacation for 2 weeks,
Hmm.
right? And you go like, hey, this is a great quick profit. I'm going to lock these in, and then try to get taken out while I'm out on vacation, so I don't have to worry about it, right? So that's another kind of a scenario, right? You've got locked in guaranteed profits, and you can take them, and then you're purposely trying to close down a little bit so you can go on vacation and relax. So we've got all these different kind of scenarios, and between um, the three numbers that you get, you've got lots of variations on the theme, and quite frankly, this is very, very good information to work with. See?
That's interesting that you mentioned. I mean, that's one of the most important things is talking about over the series of trades. And you mentioned 1,000 trades. That could take a long, long time. But the thing to keep in mind about that is that the market goes through cycles, right? Like, we just had a big up cycle. We talked about earlier how this current cycle appears to be stalling out. And so, we may get a little consolidation here. We may get a little bit of a backing and filling in the overall market or a pullback, or, we may get a down cycle. Like, I've been noticing lately that the Russell 2000 is kind of leading things to the downside here. It's getting pretty weak, and so I've noticed that a lot of the stocks. This is an interesting example I wanted to talk about, but anyway, so if we're headed for a down cycle here, then using the parabolic stops on open positions, could be sort of the thing to do. This is a really interesting example of where a parabolic stop kicked in before the stock reached the target, right? And this one never quite made it to the target, and even though it doesn't look like much, this ended up being just using the trailing stop to like over a 10% winner, right? So it made a 10% move, which is pretty nice before it came down and hit the system trailing stop. But this is kind of interesting because it's an example of where the parabolic stop kicked in ahead, and I'm guessing that was based on this long range breakout day right here. That was a pretty significant up move, and so putting in the a stop or selling half at the parabolic stop on this particular one would have worked out pretty well. What's interesting about this is how it had this flat top breakout here, and then it sort of attempted another one here and just couldn't quite get it. And you can see that using that system trailing stop would have basically prevented you from giving it all back. And so that's why I think this whole idea of ratcheting the stop up along with the price is the killer winning strategy, right? Because stops are tough to manage. And the other sort of, piece of the puzzle that I really like about this system is that it's not an all or nothing thing, right? Now, like you said, you can choose to, sell it all just using the trailing stop, but I sort of think that psychologically, if you get into a stock, you're sort of monitoring it, you're ratcheting the stop up, and if you start off with the mindset that you're going to scale out in say two different transactions, that means that, say you got in and you took half off at this parabolic stop, and then the next day, instead of selling all of it, the next day it pops up and then it starts to go up more. And so you're still participating in the stock, right? You haven't sold all of it. So psychologically, you've already got a profit going, and, you're still in for a little bit in case it keeps just running up. This one had a good.
Yeah, in hot markets, we get really good follow through. You'll A lot of times you can see follow through three times of what the system target would be. Remember, the system target is just a first target, a quick high frequency win target that you're going to see hit a lot. And but yeah, here's what I would recommend folks do. If you just look at the closed trades table, and you can kind of do tape reading on that sucker. You can look at that and you can see the waves of green, and then you can see where we have some stop outs, little cycles of stop outs. One thing you're going to notice in the closed trades so far, and this is all system generated. We don't sit and pick these stocks. We don't figure out where to take the entries. We don't figure out where the targets are. It's all automated. It's very cool mechanical system. And so the system does all that work. And so what I want you to notice when you take a look at the closed trades is look at the number of winners versus losers. You'll see we got a lot more winners in there than losers, and that the gains are bigger than the stop outs, right?
Mm-hmm.
On average. I mean, so you'll see we've got some, and you can see that's where there was like a down cycle in the market where there might be several stop outs, but they're very tiny stop outs compared to like some of the big winners. So the moral of the story is it's the good old fashioned, let your winners run and cut your losers quickly type of an approach, right? And that's what really works in the market. So yeah, it behooves you, if you can, get to the point where you're holding some for the longer term, swing trader / position trader. That's where you're going to get the most bang for your buck. But you'll be able to see. So like right now, if we see the market go down on the weekly time frame, the next couple of weeks, and you start seeing a wave of stop outs in there, that's your that's your little signal to be less aggressive and maybe take profits quicker. And guess what? That's what everybody else is doing. That's why the market's going down, right? Because the market is skitsy and there's quicker profit taking. So
Yeah, well, that makes total sense. I mean, like I said, the market sort of moves in cycles, and we've had a big up cycle since the beginning of the year, and I mean, here we are. Geez, we're in March now. This weekend is the weekend that we set the clocks ahead, like
oh
the
brother,
the
yeah.
time change. Well, it's
We
actually
so
kind
we
of
lose
nice.
an hour, right?
We lose an hour of sleep, but the good news is it stays light later, which to me is the big benefit of it, right? I mean, I hate it when it's dark out. You know, the market closes and an hour later it's dark out, and so now we're gonna spring forward, and so it's gonna stay light later, which I think is kind of nice. I actually enjoy this. I pulled up this other example. This is still an open trade, although it's getting dangerously close to the stop, which would be fine. I mean, this thing's been open since the beginning of January, but this is another interesting case, and I wanted to take a look at this because this is a case where the parabolic stop kicked in well before the target, but it never actually got tagged, right? Like it kicked in, I suppose, at the close of 122, this day here where I started it, and it was basically just a little bit below the low of that day. And you can see over the next few days, the stock kind of went sideways a little bit, and then it actually kept going towards the target, right? And so, what I've sort of gleaned out of the system so far, and like I said, we've sort of been through like one market cycle here, and the interesting thing about creating a fully automated back end system is it sort of takes on a mind of its own, right? Like I observe what's happening with the system, but when you program logic in, especially the logic of, picking the stocks and choosing the entries and I mean everything about it, it sort of takes on a life of its own. And so by observation, I've noticed a lot of interesting things. One thing I've noticed is that it seems to be working really well, but it's just interesting to look at the different stocks and that's sort of how they manifested and how the stops got moved and the parabolic stops. I mean, it's like a lot of pieces to a puzzle, but it all fits together perfectly.
Yeah, this swing trading system is the most complex trading system that we've come up with yet, and it's very clever because what's neat about a system like this is that think about this way. This in no way diminishes the effectiveness of the system, but the system is not integrated so much in that it knows like every part of the system knows what every other part of the system is doing, right? A lot of this stuff is isolated analysis that's been quanted out to work, right? So the stocks that even make it into the list, they have a certain filter that proprietary filters that we've come up with to get them in the list in the first place. The trigger is our best setup of that we've come up with in, well, 2 decades now, right, Bill? We've come up with a lot of swing trading setups over the years. This
Sure.
one is the best. And then just the methodology of how the stops get, because it's all about the stops then, really. Obviously the target gets generated. That's kind of a little proprietary thing that we've come up with. And then it's all about the trailing stop. But the trailing stop and the parabolic stop and the target and everything is separate analysis, but we can put it all together to make it work in a full-on system. So yeah, you're right. It is interesting how it takes on a life of its own. But to give you an example, the trailing stop has four types of logic to get to move the trailing stop, right? The parabolic stop has 7 different types of logic
Hmm.
that it uses to move it or analyze. it. The target is a one-shot deal. Like I said, it gets computed one time, and that remains like a static target. Uh, but yeah, this is a very nice system, and the great thing about it is that it is a very low stress, easy on your nerves, easy to follow type of system. You don't want to get hung up on any one trade. Just treat each symbol that comes through the pending list, you treat it as a potential vehicle to park some cash over the short term, right? And go for
Mm-hmm.
the ride. That's it.
Interesting. Hey, Don is chiming in here, and he says, "Do you have a calculator we can use to set or update stops? At times, I'd like to move the stop up during the day, and it would be useful for selected stocks and for my own scanned picks." We do have a couple of calculators coming, right? That's on the drawing board, and they should be coming in pretty soon. I know that we're talking about a couple of position size calculators, a fixed risk calculator, if I'm not mistaken, where you would be able to put in a stock and say, okay, on each one of my trades, I want to risk, $100, right? That would be the fixed risk calculator, and the other calculator would be what's the name of the other one? The dollar.
Yeah, well, it'll
The,
be a calculator that'll help you to determine how much of your capital to employ for each trade.
the
There's a,
position size.
Yeah, they're both position sizers. Now, as to the question about the moving the stop intraday, the well, the swing trading system, since we're swing trading and holding overnight, is an end of day system. So there's no way for the system to gauge anything intraday because we're just waiting for closing data all the time. As far as intraday stops, uh, I would point you to using a 30-minute chart, right? And
Mm-hmm.
trailing up below your 30-minute bars. That is going to be the easiest way to, so for instance, let's say that you're in a stock that is running your favor and it's really going gangbusters and maybe even gaps up, right? Then you can follow up on a 30-minute chart and follow below your upwards, moving 30-minute lows.
Mm-hmm.
That's really the best way you can do an intraday stop, in my opinion.
Yeah, sure. Using something on the chart. I'm not really sure about an actual like a calculator. Maybe what he's asking about would be like that calculator that I've seen you had in the past that showed you like you type in two prices and it shows you the percentage difference real quick. That's always a handy one.
Oh yeah,
That's
yeah.
yeah, that's
Yeah, we'll have stuff like that. Basic calculators as well.
Getting back to the parabolic stop, I thought this was a really interesting. This was an interesting case because, like I said, this first parabolic stop kicked in before it hit the target, but it never got hit. It allowed for a little bit of a little move, but what's interesting is that the next parabolic stop kicked in after shortly after it hit the target, and this one never got hit either. You can see it looks to me like it's being calculated just below the low of a certain bar, right? And this was a pretty good move. This is like if this was a candlestick, they'd call this like three white soldiers or something. Right? This is a really nice 3-day move, and so that parabolic stop ratcheted up here, and then you can see another one got generated here, which is kind of interesting because, like you say, there's a lot of different calculations going on. This one was actually above the low of the prior day, which did not get hit. And then so finally, this is the one just a couple of days ago, and you had a big 4-day up move there. So this was the first parabolic stop that got hit, right? And it's just kind of interesting to see how the trailing stop also ratcheted up past these parabolic stops, and it looks to me like this stop finally is looking like it could get tagged here. But the funny thing about this is there's been several pullbacks in this stock, right? And a little pullback here, little shallow sort of pullbacks off the high, and this is very similar to what we're seeing now. sort of a shallow pullback off the high. And so, hey, you never know. I mean, if the market were to turn around today, this stock could close in the middle of the range, and then tomorrow, go up again. I've seen that happen a lot of times. I've seen, sort of like this one where the stock looks like, okay, it's done for. It's going to pull back, and then lo and behold, the markets may be weak in the morning, and then in the afternoon it rallies back up, and then the next day, we continue higher. So we've seen a few fake outs like that.
Yeah, you can't predict the market. You can only play it, right?
Yep.
So get out of the prediction business and learn how to play, tactically the patterns, and that's the best that can be done. But yeah, that's a good example. Originally when I was designing the parabolic stop, I was considering only having the parabolic stop kick in after the target was hit, like above the target, right?
Hmm.
But we have so many good instances where it's it's between the target and like a parabolic move, and so you can, like in this example here, you can get to, a bracket where you basically bracket around price. You're either going to hit the target or you're going to hit the parabolic stop. Either one's a win, right? Win-win.
Sure.
So that's why you'll still see like the parabolic moves, and this one, because it moved, it kind of moved parabolically, but it also kind of, the lows moved smoothly. Like you said, the normal trailing stop kind of kept lockstep with the parabolic quite a bit there.
Yeah, this is interesting. I wanted to look at check it out. So I'm gonna pull up Facebook here. There's a little bit of a delay in what I say I'm gonna do and what you may see on your screen, but most of the viewers won't notice that. Anyway, Facebook's kind of interesting because this is one of the newer open positions here, and it's got just a really sort of interesting pattern going on, right? I'm going to draw sort of a trend line across the price action that occurred right before it triggered, and there we go. You should see that show up on the screen here in a second. What's interesting about Facebook is that it had a pretty decent technical pattern here. There was a big gap up, some consolidation, and then a real nice little sort of shallow dip, right? Trend line break, and then there was a trigger right there. 164.35. And there was a little volatility around the point of entry here. Pulled back for a couple of days and then just sort of took off here. And even today, it gapped up. And so I'm thinking that just kind of looking like today might be the first day, or after the close today, I should say, this might be the first day that we actually see the initial stop ratchet up, right? So, I mean, the key to it, I suppose, is having a good initial stop in so that, in case this thing just turned around and tanked, right, and filled this gap, you wouldn't want to be in for all that. So seems like a very minimal risk here, and then it's starting to work out. Would you expect this stop to ratchet up tonight?
It may, or it may take another day or two, but this is a stock where, you know, you have the ability to get to break even also on your trades, through your own discretion. And what we look for is we look for three higher lows above your entry. Now, in this one, if you took the entry at above the trigger there, you've got two lows that are above your entry, but this is such a big pop up, parabolically, you can, you could feel safe going to break even here, is what I'm trying to say.
That does sort of make sense.
Yeah, because I mean, look at, you popped up above the previous high there. You've got, big move in your favor. If you calculated out the percent, so the point is the general guideline is three higher lows above your entry point. But if I was in this trade, I'd already be at break even on this one,
That makes
right?
pretty good
Yeah,
sense. Yeah.
and the reason why is if the stock keeps going higher or maybe trades sideways a little bit or even pulls back a little bit, your trailing stop's going to start moving up there anyway.
Hmm.
So this is just a way that if you wanted to do a discretionary move, you could like get to break even on this particular one. Uh, Again, or not even stress out or worry and just let the system tell you what to do. See? So,
Interesting, interesting. Huh. Yeah, let's look at a couple of more examples. This tech TECK is sort of an interesting example because it's already had a. I've noticed on this particular one, you'll see this come up on the screen, is that the initial stop still hasn't moved on this. And it's been, well, I mean, it's been a week and a half, almost 2 weeks, but the stock's actually had sort of a pullback cycle towards the prior low and then made a little bit of a higher low, and now it sort of looks like it might be ready to to go again. Let me ask you this. Let's talk about add-on positions. I know you've talked about this in the past, and we don't really have any provisions in the software as far as like an add-on, but is that a viable strategy? I mean, in a good market environment, and you got a stock that is sort of moving in your favor and looks pretty good, and everything seems to be lined up. Is it possible, or is it advisable that maybe you would want to add on to a position?
well, sure. Let's say that you were following a methodology where you were going to be like a swing trader, slash position trader, and you were taking the entries over the short term on the short term pattern, and then uh, you could take half off on the profits, right?
Mm-hmm.
Half off on your, let's say, the system target, or a parabolic stop, let's say, and then hold that other half just using the system trailing stop. And then here's, we don't really have any good chart examples to show you, but in your mind's eye, this is how you do it. First of all, you only add on higher than your initial entry, right?
Mm-hmm.
So you're averaging up. Now that right away, that people go, what? Why would you want to buy higher? Because when you average down, you're basically feeding money into like a losing position that's going against you. When you're averaging up, you're feeding money into a performer, something that's actually working, right?
Mm-hmm.
So it's kind of like betting on a horse race, and you get to add, increase your bet as your horse is winning around the track. Think of it that way. So the real simple way to do it in your mind's eye is um, to uh, look to enter above a pivot low, and that pivot low has to be above your entry. So in other words, you wait for a stock to uh, put in a pivot low day. And a pivot low is basically, think of it as like a one day that spikes down. We can probably see some examples here. One day that spikes down, and then you got 2 days on each side before and after that the lows are higher, right? So it's like a little needle sticking down. And so anyway, that pivot low, that spiked low, if that is above your entry point, right,
Mm-hmm.
then you can do a potential add-on, right? And the reason, one of the advantages to averaging up is that if you do it correctly, right, and you don't have your sizes lopsided or anything, every time you add on, you basically, your average share price will still be down below where the stock is trading. I mean, that's the goal. So even though you're adding on, you could still maintain like a break-even stop. So, but
Interesting.
that's a good point. I should research out and see if there's a way to put it like an add-in signal into the open trades.
A quick question on this one, and then we'll move on. Suppose somebody was looking at this, and maybe they didn't get into it. Is it still viable here? I mean, is this still trigger still viable, even though the stock's kind of moved above and back below it? I mean, it kind of looks this kind of a decent looking chart to me, to be
Well,
honest
sure.
with you.
In other words, the very next day that closes back above the trigger line, you can treat it just like it appeared the first time, right?
Okay.
Because your stop is still in the same place, and yeah. So if you didn't get in on the first one, remember the trigger line. is a basically a balance point to where we're looking for the stock to perform above that level, and then it's a go. So whether it takes hims and haws around a couple of days, as long as the stock trades above that level, it's a potential trade.
Interesting. There's one that got opened basically yesterday that I wanted to look at here. This is a pretty expensive stock, this NTES, but I noticed that it has a pretty interesting pattern on the chart when you zoom out a little bit. On the chart here, there's this thing really like cycles up and down big time, right? It's fairly volatile for being such an expensive stock, but just had a really nice sort of, I would say, long duration pullback, right? Practically a month, and kind of bottomed out here around sort of some levels where it found support previously. And it's just interesting to me because there was a big long range day yesterday that kind of triggered it in, and today, so today would be, it was on the triggered today list last night when we updated it. And oh, for you folks that have been asking about what time the updates are happening. Since the system is relatively new, we just launched, fired it up at the beginning of the year. Each night we're doing the updates just a little bit later so that we can go over everything and trace everything back, look and just to make sure that everything's working perfectly. So, and it has been working pretty good. So, anyway,
Yeah, we're still in complete review mode where even though the system does all the number crunching and spits everything out mechanically, we still go over every single thing with a fine-tooth comb and make sure that it's correct. And this helps us, come across anomalies. You get stocks with very strange behavior. You got to figure out how to deal with them. So this process will go on for a little while, but in the future here soon, we should see updates occur within 2 hours after market close each day.
oh, okay, no big deal. I usually in the morning is when I typically look through these. I mean, after we go over them at night, and I look and make sure everything looks normal. In the morning is when I really think is a good time to, you log into your broker in the morning and you update your stops and that type of thing. When I look at this particular chart, this target looks very achievable. This stock has had lots of sort of pullbacks and then right back up, and then it pulls back and then right back up, and there's a lot of zigging and zagging happening here. But when you zoom out on this chart, target looks pretty reasonable if we get some follow through in this up move. What I noticed was this last sort of sell off in January, right? This thing snapped right back literally in 4 days. Like this move right here, at the beginning of January, that 4 day move looks basically like if this thing, would run straight to the target on a similar move like that. So just kind of interesting.
Yeah, one thing about trading that you learn after you've been trading a long time and you've gotten through lots of trades is that we get two flavors of follow through. Super smooth and beautiful and super sloppy, but they still work, right? And this goes back to having a mechanical, quanted out system that you don't have to second guess and micromanage and go, oh, this one looks sloppy, therefore I don't like this one, right? You want to get away from that because uh, to get into the system, all these stocks have to meet like certain criteria, and they trigger correctly, and everything gets computed out the same way. So the point being is that we are going to have trades that look sloppy as heck, but they still make it up to their targets, right? And the trailing stop still works. And that is one of the most difficult things about being like a self-styled discretionary trader where you're doing all the analysis is you end up in like analysis paralysis a lot of times, and you overthink things, and the market's got a sloppy, fudge factor to it, uh, built in, right? We can never get around that. So this system helps you kind of just avoid worrying about that kind of stuff. And again, over the series, everything averages out. The super smooth trades and the super sloppy trades all kind of average together, and you get your, things pencil out over the series. That's what you're going to see.
Interesting. While you were talking there, I did the calculation on the distance from the trigger price and the stop here, which is 6.5%. Maybe that's what Don was talking about. That little calculator where we could type in like the entry price, where the stop is, and that way we can figure out exactly like what the distance is percentage wise between. And of course, you're not gonna be entering right exactly at the trigger price. This thing opened a little bit higher. And so, we're talking about 7% here, which is pretty reasonable. And so the idea is that position sizing is really the key. And I think that that's probably a good topic for next week is to talk more in depth about position sizing, how many open positions one would want to have, the different variations on that too, because I know there's a couple of variations. And so, yeah, let's save that topic and talk about that next week. I think that's probably, but that is one of the keys to the system, right? Is like you say, having it so that even though this would be like a 7% stop out, shouldn't be any big deal in the big scheme of things. Like if this one didn't work out, right?
Right. If you can start with very small position sizes, diversify a small amount, and just again treat each of these trades as identical, and they're just areas to park money over the short term, then any stop outs or any series of stop outs should not be catastrophic for you. They should just be small little hits. The hallmark of any good automated system is that it can self-correct after periods of drawdown, right? Because the market basically, no matter what kind of system, whether it's a day trading or a swing trading or investing or and no matter how it's designed, your systems go into alignment with the market and they go out of alignment with the market. And you could look at it the other way. The market lines up with your system during periods of time, and then it falls out of alignment with your system. So you can incur either periods of drawdown or just your gains aren't that stellar during a short period. But the hallmark of any good system is that it will self-correct, because what we're doing is we're playing, we've got the statistical odds built in our favor over the series, and the fact that the market can go into a good long stretch, let's say to the upside, then basically we're locked into really high odds in our favor during a long period of time, right? And that's where you rack up all the gains. So anyway, that's the way to think about that.
Interesting. Yeah, well, I want to go ahead and wrap this up here. Real quick, did you see all the lines that I drew on this? I mean, they're not perfect, but sort of a bigger picture. One of the reasons that I kind of like the look of this, the bigger picture here is that you had, sort of a big sell-off throughout 2018 on this. This is a Chinese stock. And then you got a trend line break there. You got kind of this W pattern going on here. And then you notice that after you broke this trend line, you've had a series of pullbacks, but also connecting these lows here, what you see is sort of a series of higher lows that's manifesting here. And we just had this pullback to, basically the higher low trend line. And then you got a shorter term trend line that broke. So, this has got a pretty good look to it, quite frankly, from a few different vantage points, right?
Well, sure, yeah. The stocks that make it into the list in the first place to even go into the pending list have to meet criteria where they have uh, momentum to the upside and they're under accumulation, institutional accumulation. Now, again, that doesn't predict anything. That just lines us up with the best performers to work with, and then it's always about timing of the entry and the tolerances around our entry point and our stop, and that's where depending on the volatility at the point of our entry and market momentum in our favor, we see the follow through. So again, if you're here's the thing: if you're just starting off with this system, keep in mind, if the market heads lower over a week or two, you could see the follow through diminished on some of these entries. But again, it's short term, and you want to stay in the game because any good system will self correct.
Interesting. Well, hey, I want to thank you for coming on again Wednesday and some really good information there. And so next week we can dig into the position sizing idea a little bit more. So thanks everybody for coming on the show. Thanks, Jeffrey, for all the good info, and we will see you next week.
See you next week, Bill.
All right.